With business growth comes additional challenges. The initial founder, the initial business owner will find it next to impossible to do everything themselves. Even if they perhaps exhibit the characteristics of Superman, you can't do everything. And individuals will be helping you, you'll be employing teams of people, you'll be employing freelancers and the like. And what we need to do is have a system of actually being able to manage all that. Well, we're going to talk today about responsibility accounting. Now, this is not about being a responsible adult. This is about implementing a methodology within your business, within your organization, to actually allocate responsibility and accountability, by the way, folks, to your teams within your business. So I'm going to, in this video this week, to explore what responsibility accounting is and some flag up some key considerations so we can get the best out of the system. So what is responsibility accounting exactly? Well, as the name suggests, is whereby we allocate responsibility, and I would add accountability, to those individuals and those teams within our business organization. And they're going to be responsible and accountable for a number of different things. Now, it means that those teams can take ownership and responsibility for those matters which lie under their control and remit. We can judge their performance based on the responsibilities that we've allocated. We can establish performance indicators. We can allocate decision-making authority and responsibility depending on what we've allocated. So all of it becomes much easier to manage, and therefore we can make our businesses much more effective. Now, you might be sitting there thinking, okay, that's all very well and good, Mahmood, but why is it so important to us as a business to understand what responsibility accounting is all about? Well, apart from being able to manage your costs much more easily, apart from being more efficient, apart from enabling better decision making, what it also means is if managed correctly, if managed effectively, the sum of all those individual parts are going to be a very powerful force for your business. Now, that's all very well and good, but what should we do about actually implementing a system within our own businesses, or perhaps revisiting and having a look at what we already have? What I'd like to do next is to introduce you to the types of responsibility center, as they call it, they're just throwing a bit of a buzzword here, that you can have within your own business organizations. Now, responsibility can be allocated in one of four ways. You can, in your own business, establish what you might call a cost center. Now, a cost center is any area within your business where costs can be attributed and an individual assumes responsibility for that cost control, for that cost management. So typically in a business which may have perhaps an accounting department, had to get that in there, or an HR department or an IT department here, that budget holder is going to largely be responsible and accountable for cost control, for cost minimizations, and for managing that budget that they're allocated itself. Their performance is based on the costs that are within their area of responsibility, and in principle, they will be judged on what goes on within that area. Now, another area of responsibility is what's called a revenue center. Now, it's not that common for businesses to have revenue centers, but they do exist. So typically, that might be allocated to someone in your sales team, and their primary responsibility, they're primarily going to be judged on the revenue generation that ensues. So any performance measures, which we're going to talk about next week, any performance measures, any judgments that we make will be based on how they perform in sales terms. Now, as we move up typically the hierarchy of management responsibility in a business, we come to what's called a profit center. Now, if you've got an area of your business that's allocated as a profit center, so perhaps you've got somebody who's in charge of business development, you tasked them with generating profit within that remit, they are responsible for generating revenue, they are responsible and accountable for cost control, and also for achieving profit levels that you're going to be establishing. The last area of responsibility, and typically we meet this in divisional setups here, is where somebody is in charge of what's called an investment center. Now, an investment center, folks, by the way, is not where you're responsible for stocks and shares. but it's where that management team, management setup, have the authority to make what they call capital investment decisions. So they have the ability to invest in plant and machinery, capital equipment, and on that basis there, they are going to be accountable now for cost control, for revenue generation, also for profitability, and also for how they utilize those investments, that investment in machinery and plant, and look at the revenue that's generated and the profitability that comes from that. Now, in next week's I Hate Numbers video, bit of a spoiler alert here, I'm going to dive a little bit deeper here and actually look at what we call KPIs that we can establish, the measures that we can establish, and how we manage them within those areas of responsibility in our businesses. Now, let's continue. When we decide to judge somebody's performance, we have to have what I call a state of equity that exists. So that means a state of fairness. So if, for example, you make somebody responsible for cost control, for somebody to managing those costs, you've got to make sure those costs that they're judged with are controllable. So do they have the ability to influence, to impact on those costs? So if there are costs such as foreign exchange gains or losses, if there are things like supplier price increases, you could argue if they don't have the decision authority to make those purchasing decisions as such, then they shouldn't be accountable for those costs. Macro costs outside of our control, like inflation, are not normally controllable at a certain level, and therefore we shouldn't judge somebody's performance on that. Items such as rent on the building, the premises, again, typically, if that budget holder does not have influence over that level, by all means have it on their budget line, but they shouldn't be ultimately held accountable for that cost. Now, in terms of a typical semi-medium large organisation where we might have several departments there may be shared costs across the board. There may be also costs that link to other departments. So if I'm a manufacturing company, for example, I might decide to send one of my staff team on a training course. Well, the training budget as such will be held by HR. The benefit is going to be felt in the production area, and therefore there may be a discussion to be held that cost should be split across the two boards. Now folks, let's have a think of where we are at the moment. So we've got this idea of responsibility accounting, and ultimately it's about empowering people, it's about making judgments on how we're performing, and we allocate responsibility based on the areas that need to be managed in our business. Typically from HR to accounting to legal to procurement to manufacturing to distribution, all those have different functions, all those have different responsibilities. The budget holders, the managers in that organisation will have judgments based on how they perform in terms of either a cost level, a profit level, a revenue level, or making those investments about machinery and equipment that's being procured for the business itself. I hope you found this video of value and of use. If you do, I'd love to hear your feedback. And if there's a video that you would like me to produce going forward, let me know. I'll have a look at that, and who knows, it could end up in the production schedule. Until next week, folks, I'll see you on the other side.